Hello everyone. Today we will discuss about stock buyback or share buyback. As you know, recently Infosys went for stock buyback and the share price of Infosys surged during this period of time. So, stock buyback is an important corporate action which influences the share price of the company. In today's session, we will discuss about the corporate action of share buyback. So, we will discuss what is share buyback, how does it work, why do companies go for share buyback, and how do we benefit from share buyback. The share buyback is an economic activity whereby the firm repurchases its share from the investors. So, when the company repurchases its shares from the investors, the market capitalization, and in the market capitalization, the number of shares available for the public will reduce. And as you know, when the supply reduces, the share price increases. That is why whenever there is a share buyback from a particular company, the stock price of that company tends to increase. And as you know, when the share price increases, the EPS also increases and the PE ratio reduces. So the company becomes undervalued. So whenever the company is overvalued, the company goes for share buyback. There are two methods of share buyback. One is tender offer buyback and the second one is open market buyback. First of all, let us talk about the tender offer buyback. In a tender offer buyback, the company fixes the record date, and before 3 days of the record date, the investor should be holding that share in order to participate in the share buyback. And the company gives 10 days period to participate for the investors in the share buyback. And there will be a separate platform for the investors to participate in the share buyback. In the tender offer buyback, the company purchases the shares directly from the investors. It sets the buyback price higher than the current market price. Only if the buyback price is higher than the market price, then only investors will be ready to give their shares to the company. So when the investors are eligible for buyback, they will receive an email from the company asking to participate in the share buyback. But the company will not be ready to accept all the shares of the investors, because the buyback will happen for a fixed amount and the number of shares offered for the company by the investors will be higher than that. That's why the company will fix a ratio, and in that ratio, the company will go for buyback. For example, let us say a particular company has issued a tender offer buyback of 5 lakh shares. The investors have offered 10 lakh shares for the company. So, the company will accept only 50% of the shares of the investors. For example, if an investor has 100 shares of a company, the company will be accepting only 50 shares. So they will receive an email, and after the record date, the number of shares of the investors, in the example I have given, the 50 shares will move from the demat account of that particular investor to the company, and the amount will be credited to the demat account of the investor. The second one is open market buyback. So in the open market buyback, the company buys the shares from the market, not from the investors directly, but from the market. And in the open or market buyback, the company will set a limit price, and the company will not go for buyback above that limit price. For example, let us say for DC Limited, for that open market buyback, the company has fixed the maximum limit of rupees 70. The share is trading as of now at rupees 50, and the company has decided to go for buyback of 1 lakh shares. And the company has to complete this open market buyback within 6 months. Always remember, the open market buyback has to happen within 6 months. So the company will buy this 1 lakh shares whenever the price is below 70. If the price goes above 70, it will not be buying those shares. Only when the shares price is below 50, then only the company will be buying those shares. And when the company completes this 1 lakh shares, then the company will stop this buyback. So this is how the open market buyback happens. The next aspect is why companies do share buyback. Companies do share buyback to increase the ownership value. So whenever the shares are undervalued, that means whenever the share price is less, when the company shares are trading at a lesser value, to increase their value, the companies go for share buyback. When they do the share buyback, the real value increases. For example, let us say there is AB Limited and the share value is 100 crores. And also the number of shares in circulation with the public is also 100 shares. Now the company goes for share buyback of 10 shares. Then the number of shares available with the public will be 90 shares. So previously the real value or the ownership value was 1 crore because 100 by 100. But now because the number of shares have reduced and it has become 90, so 100 divided by 90, that is 1 crore 11 lakh. So the ownership value will increase because of the buyback. The second reason why companies go for share buyback is to improve their financial ratios. Because through buyback, the companies can improve their EPS and PE ratios. How? Let us see with the help of an example. Let us say the share price of AB Limited is rupees 200. The total shares is 20 lakhs and the net profit of the company is 1 crore rupees. Now when we calculate the EPS of AB Limited, 1 crore divided by 20 lakh, that is rupees 5. Now let us say the company goes for buyback of 2 lakh shares. Then the total number of shares reduces from 20 lakh and it becomes 18 lakh. Now when we calculate the EPS, 1 crore divided by 18 lakh, that is 5.56 rupees. So now the EPS has increased due to buyback from rupees 5 to rupees 5.56. So EPS has improved. So one of the financial ratios has increased. And now let us look at the PE ratio. The formula for PE ratio is equal to share price divided by EPS. That is 200 divided by 5, that is 40. Now, after the EPS has improved, the PE ratio would be 200 divided by 5.56 because due to buyback, the EPS has increased from 5 to 5.56. So that is equals 35.97. So now due to this buyback, the PE ratio has decreased from 40 to 35.97. So a low PE ratio is a good financial indicator. It means that the share is available at a lesser cost, the share is undervalued. So with this buyback, we can improve the EPS and PE ratios. How can an investor benefit from the buyback? The first benefit is that if there is a tender offer buyback, the investor can directly sell his shares to the company and earn a profit, because in a tender offer buyback, the shares are offered for the investors at a higher price than that which is prevailing in the market. So by participating in the tender offer buyback, the investor can easily make a profit. The second benefit for the investor is increased dividend, because after the buyback, the value of shares increases. Let us understand this with the help of an example. Let us say the total number of shares of a company is 20 lakhs and the amount available for dividend distribution is 20 lakh rupees. So for every one share, the dividend that will be available will be rupees 1. Now let us say the company goes for buyback of 2 lakh shares. Now the total number of shares will be 18 lakh. The dividend available is as earlier 20 lakh rupees only. Now the dividend for one share will be more than 1 rupees because of this buyback. So buyback can increase the dividend for one share. The third benefit of buyback is increase in the share price of the company. So whenever there is a buyback, the total number of shares available for public will reduce. And as you know, when the supply reduces, demand increases, and when demand increases, price increases. So the share price of the company will increase over a period of time. And also, buyback sends a positive signal for the investors about the company. So buyback will be possible only if the company has sufficient cash reserves, only if the company has been making sufficient profits consistently. So it means that company is financially strong. Then the investors will be attracted towards the company and buy more of the shares of the company, and the share price will increase. And in this way also, even if the investor does not directly participate in the buyback, he will be benefiting from the capital appreciation of the stock of the company. Thank you.